Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho and I'm the Senior Analyst at Fully Informed Trade. So without further delay, let's go ahead and analyze all of the major markets and really talk about what I want to talk about, which is the gold and silver head and shoulder pattern towards the end of this video. But first, let's talk about the major indices and talk about what's the backstop, what's moving these markets. First of all, the US dollar index had a nice little rally towards the end of the session, which kind of crushed the bulls at the very last moment. Let's go ahead and look at the daily chart and just talk about what exactly happened between 2 p.m. and 4 p.m. in the afternoon. This is where a lot of people just got manhandled and they just got sold and they just got crushed, because if you guys notice, whenever you have a humongous rally in the US dollar or a major move in the US dollar, what typically follows is a pretty major sell-off in a big way for the Dow component. Now, we didn't really see a really major move to the downside after 10 a.m. after we should have, though, and I don't really know what the markets are doing all the way up there, but I'm assuming that what they were hoping for was something to come out of the Fed meeting, which never really did happen. It didn't really materialize, and because of that, we can anticipate much more downside, because the government or the central banks aren't really coming to the rescue, because they know that by constantly being actively involved, that they can make this issue substantially worse than it already is. And what I mean by that is that either you perpetually prop up an asset bubble, or you allow it to burst and give it some time for it to heal itself. And that's perhaps the most, because all of the stimulus spending, permanent open market operations, all of that stuff really hasn't done enough. It hasn't really justified the cost for whatever they have done up to this point. We've only achieved a 3% gross domestic product growth after the most optimal of circumstances coming out of permanent open market operations. And even then, it's being offsetted by the European governments having to cut back on their spending and their revenue. Their tax revenue base is continuing to decline as their gross domestic product drops. Where gross domestic product drops, that's very negative for the whole entire banking system, because the banks lend less money, and then in a sense you get a liquidity trap. Now, somebody told me that, oh well, the European central banks have lowered their interest rates, so therefore that's inflationary in nature. But that's not necessarily the case, because what's the very reason why they had to lower their interest rates? Because they were anticipating deflationary events. And what's worse is that these European central banks aren't willing to buy up enough bonds in the open bond market from the European governments, mainly because of the fact of moral hazard. And what moral hazard really is that these European central banks don't trust these European governments or these European leaders to do what's right for the populace, unless if they're forced to do what's right for the populace. And what I mean by forcing them to do what's right for the populace is that unless they have no choice, because if you give them the option to borrow money at low interest rates and allow them to perpetuate this issue by continuing to spend a ridiculous amount of money, addressing the issues of overspending only moderately, and trying to appease the mass populace, if that was their option, if that was made an option for these politicians, I'm more than certain all of them would take the low road. And the main reason why they would take that low road is because there is no way you are going to get reelected by cutting back on your government workforce, by cutting spending, by cutting back on employees, and also raising your tax revenues by raising the tax rate. If you raise the tax rate, you cut back on government spending, there is no way you could get high approval rates. Absolutely impossible. A lot of politicians would get kicked out of office, or they would never be re-elected into office, because it would be perceived as incompetence on the part of the politicians, and therefore these politicians would want to perpetuate this issue, this debt issue, no matter what. they would want to borrow as much money as possible and appease the masses as long as possible so they can stay in office as long as possible. And that's exactly why the European Central Bank is not bailing out these governments, because they know by doing that they are allowing moral hazard. And that's the whole issue here. It's moral hazard. And that's why I don't think any central bank is going to come to the rescue with bond buy auction or bond, I guess, permanent open market operations. They're not going to do that, and they're not going to do that until these European governments can prove to them, to these central banks, and to us, the bankers, that they can pay back their obligations based on sound fundamentals. Until we get sound fundamentals and not inflated fundamentals, not this crap where they go off and borrow money at low interest rates so they can perpetuate a debt situation even further, until they can prove to us that they can repay their money, or they can repay us the money we lent them, until they can prove that with their own actions, no central bank and no banking body is going to stop selling their bond positions, and even the European Central Bank isn't going to buy those bond positions, mainly because the European Central Bank would A, lose money, and B, they would perpetuate the problem by allowing these politicians, C, to borrow money at low interest rates so that they can perpetually stay in debt and eventually lead these countries down to bankruptcy later on down the road. So either they cut their spending now, which is what they're going to be forced to do. Their spending is going to be, they have to cut their spending and they have to raise their taxes. And that's the only way they are going to fundamentally solve their debt issue. And by fundamentally solving their debt issue, that is deflationary in nature. Why is that deflationary in nature? Because even if you kind of lower your interest rate by a tiny bit, it doesn't change the fact that you raise your tax rate by 10%. Even if you lower interest rates by half a percentage point, what is that going to do for the economy? Not much. Sorry guys, it's not going to do squat. And the main reason why it's not going to do squat is because you're essentially taxing the whole populace 10%, 15% more. And let's not forget, you're also going to cut back your labor force by maybe 20 to 30% just so you can maintain a positive account balance, or at least achieve a positive account balance at some point in the future. Now, I don't exactly have the exact quantitative measures or the exact quantitative amount of exactly how much they'd have to raise their taxes and how much they would have to cut back their workforce and how much spending that would have to be cut. I don't know the exact amount, but I do know that even if you lowered interest rates to 0% from the European Central Bank, it would not do nearly enough to make up for the losses that would happen to the public sector employment and the tax hikes. That would have a negative impact on the economy. And remember, recessionary economics means deflationary economics, and when you have deflationary economics, all assets have to revalue themselves to the mean average. Okay? That's what's going on right now. So you guys can say whatever you want about the lowering interest rates, blah, blah, blah. I'll tell you the truth as it is. These interest rates are almost meaningless. You could lower interest rates down to 0% and you would not be able to avert a major recession in some way or form. Okay, the Euro-US dollar has continued going lower, and the main reason why they continue going lower is that people don't have confidence. I don't have confidence in the European government and the European banking system at all. Moving on, the European Japanese yen. Again, right here we're getting a nice little bounce going into the 1 a.m. session. Again, 1 a.m. we've only had 1 hour to really gauge the performance of the European Japanese yen. On Tuesday, though, the European Japanese yen had continued to sell off. I wouldn't be surprised if the European Japanese yen, Euro-Japanese yen, continued to sell off, mainly because the Euro-Japanese yen pair are going down in value, mainly because of the fact that European banks are very doubtful of their own position. The domestic banks within Europe are going to continue to sell their bond positions, and they're going to reallocate their capital into the low-risk or non-risk trade into the Japanese Treasury bond market. The main reason why the Japanese Treasury bond market is very safe and stable is because, again, 95% of the debt that's owned in Japanese treasuries are owned by the native populace of the Japanese citizens. And let's not also forget that there is a really, really high savings rate in Japan. So again, the Japanese treasuries are less exposed to the risks of perhaps a bond market sell-off or anything up to that extent, because so many people in the Japanese economy buy Japanese bonds. It's a moot point. We're not going to see the same exact issue coming out of Europe, at least not anytime soon. Okay, so again, Japanese borrowing rates will remain low, and the Japanese government has a lot of access to credit in the credit market because a lot of people lend money to the Japanese government. So again, Japanese government is fairly safe right now, even though they have a 300% debt to GDP ratio. Now let's talk about the silver and the gold head and shoulder pattern right here. Okay, head right here. No, this is a shoulder. This is your head, and here is your next shoulder, right here. Okay, now here is your neckline. We've already broken the neckline, and we're also below the 20-day moving average. Let's also throw in that 50-day moving average. We're again on the silver chart, we're below the 200, the 50, and the 20-day moving average. Again, my optimism is dry. I am short the AGQ, which is a leveraged silver trade, and essentially my viewpoint and my outlook on silver is that this could go substantially lower just because it has already closed below the neckline on 2 consecutive trading sessions. Again, this is one head and shoulder pattern, and here's another. And here's for the gold chart. And this is a gold Forex chart. So again, this right here is another head and shoulder pattern. And once it's broken, guys, do note, since it already has been broken for the most part. Again, but the thing is that now we've broken the head and shoulder pattern and we're below the 200-day moving average. So, ooh, we're in trouble now because we're below the 200-day moving average and we're below the neckline on the head and shoulder pattern. That's very negative in nature, and I do anticipate much more weakness in the gold chart and the silver chart. So just for review, both the gold and the silver chart are below their native 20, 50, and 200-day moving averages. They've both confirmed closing below those main moving averages, and they're below the neckline on those, and they're below the neckline on the head and shoulder pattern on those charts. So negative outlook for both the gold and silver market based on pure technical analysis, and that's also being supported by the currency fluctuations that are going on in Europe and the doubt that's coming from European regional banks. The deflationary outlook still holds because of the fundamental economic macro concerns. Take care, folks, and I hope you guys have a wonderful trading day on Wednesday.